I'd just like to begin by acknowledging the traditional custodians of the land on which we meet today and pay my respect to their elders past and present. I extend that respect to Aboriginal and Torres Strait Islander peoples here today, joining us in this virtual room. All right, some very quick admin. This is the most dry part of the presentation. Look, I do have to give you what's called a general advice warning, and that's just to say that most of the concepts that we'll cover today will apply to most people, but not every concept will apply to everyone in this room. So as such, the information we cover is general in nature, and I'm not taking into account anyone's financial situation or needs. I'm sort of saying these are the different strategies you can use, and then you go away and apply them to your own situation as you see fit. Moving across to something like personal advice, that would be when I was, I understood your situation and said, with this amount of funds, do X or Y, and that's personal. There are financial planners on staff that can do that for you, but today's all about general and understanding superannuation and the scheme. Hopefully you'll go away with things that you can update and change yourself, and you don't need to go down that path, and you've got something out of today that's really usable. All right. Okay, so look, we're going to take a closer look at how super works. So it's from those first contributions into super when you first start work, all the way through to retirement. We'll talk through that super journey, sort of focusing on the three main levers that sit within superannuation. That's contribution, so where the money that goes into super comes from. Your investments, so how we manage money for you and on your behalf, and our investment team and what they do. Also, we'll talk about insurance, so the protection that may be included with your super. A lot of people think of their home or their car as their most expensive asset that they own. But I think we forget sometimes that if you're young, if you're in your 20s and you're going to work well into your 60s, the biggest asset you have is probably the ability to work and earn money through your lifetime. It's probably going to be well and truly more than the property that you own and things like that. So just be aware of that. So we'll touch on insurance and making sure that's protected. And then finally, I'll just finish on some practical next steps for you and give you some, other places you can do research or people you can speak to and other options around that. The first thing I actually want to do is have a little poll so everyone can get involved and just give me a bit of an idea of, how your knowledge on superannuation is. Are you an expert? Do you know enough to kind of get through? Would you like to know more? Some people explain superannuation to me. I speak to people in Defence Force that have come from other countries. They do a lateral transfer. They've never seen superannuation in their life in the way that we do it. They might have their UK pension or whatever it is, but superannuation is completely different. So it's a new thing to them. So let me know where you sort of sit with superannuation, and I'll tailor a bit more of this around it. Excellent. I'd like to know more. That sounds fantastic. Love it. What superannuation? Brilliant. You've come to the right session. Excellent. That's everyone through. That's great. Unfortunately, I feel like schools don't teach enough about superannuation. I think they still register you for your tax file number when you're 16, and that's about all the financial education that you do in our school system. So let's get into it and let's start really drilling down on the superannuation. So CSC, we administer the superannuation funds. So we actually administer 11 funds. And essentially we administer only funds that are built for public servants and Defence Force. So we've been doing this for over 100 years. So we've got a long-standing history and experience and understand the unique needs of government employees and Defence Force members, given that's the only people that we do serve. So with those 11 funds, there's only 2 that are available to new members. That's this PSSAP or public sector superannuation accumulation plan, and the other one's a defence one, so you have to be a member of the Defence Force. So once you hold your PSSAP account for 12 months, or you're an APS member for 12 months, you can actually take this fund with you for the rest of your life if you choose to do so. So this is something that you can take even after you leave the APS with you into your next job role as well, and make sure that you're still getting those services. You still get to come to sessions like this with me. We do public planning for retirement, how much is enough for retirement, those kind of things as well. We do sessions on investments and drilling down into different contributions too. So that's all part of your administration fee that you charge with your fund. We come and provide these sessions. All right, so what is super? The most basic way about thinking of it is it's a way to save money for when you retire, and it's tax friendly. So the whole design of it by government is that it helps give you income when you stop working and retire from the workforce. Plus, on the way to retirement, it provides insurance to support you if something unexpected happens while you are working. That's legislated. It's about providing dignity in retirement is one of the words they use. But essentially, it's there to provide you an income when you stop working and retire from the workforce, and give you, a bit of peace of mind when you're working, that if something happens and you need to step away, that there is insurance there. And we'll talk about that near the end of the session. So it's a compulsory way to save for your future, really. Your employer puts a percentage of your earnings into your super fund. You might have heard the phrase bandied around, the super guarantee contributions, or SG. When this money goes into your super account, it's usually taxed at a lower rate than your regular salary, just 15%. So most Australians pay approximately, their marginal tax rate's about 30%. So you're not paying as much tax on the money going into super. So this lower tax rate's designed to encourage and reward saving for retirement or saving for your future through superannuation. Essentially, your employer pays you, but keeps a part of it and transfers that to superannuation. So on that transfer to super, you're only taxed at 15%, whereas you are taxed say 30% before it goes into your bank account. So it's kind of splits off in two ways, two different tax rates. And then that money that's contributed into superannuation is invested based on the choices that you make. So it's invested in things like shares and property and government bonds and those kind of things. And you can actually make the choices around what you do with those investments in your superannuation. And it's usually suited to your stage of life. So your investment component is all about, do you have a long time to retirement? How much risk do you want? Do you need to make up more time? So you can pick and choose, and we'll cover off on that. But at the same time, a portion of your super covers insurance premiums. So that's that insurance that gives you peace of mind. If you become either temporarily or permanently disabled, there's insurance there for you. Or if you pass away, there's funds there for your family needs, basically, so that your family can manage your super or assets and problems or debts afterwards. So all these parts, your contributions, investments, and insurance, they all come together to build sort of for your future. So you're putting away a part of your income every fortnight, and that's part of building your future. So hopefully your future self will thank you. But let's go through each component in more detail, and I'll start with contributions because that's really where everything starts. There's some different types of super contributions, and based on those types, there's some different limits on how much you can contribute. Your super savings will build up over the course of your working life, and as money's put into super by yourself or by your employer, it'll keep building. So I'll quickly run another poll, and while I put that poll up, I'll just double check for questions as well. But essentially, do you know how much super you get paid from the APS at the moment, or your super guarantee amount from the APS is. I did see a question pop up as well. Talia, absolutely ask questions in the chat, fire them there. If I miss anything, I will come back to them at the end. I know there's a couple of different methods there for you around FCS and OTE. With that one, I'll be honest, I probably won't know your particular agreement that sits within your group. I would chat to your payroll and accounts team to discuss how your FCS is essentially calculated on that one, just because across the APS, there are some different agreements depending on who it's with. I think Teddy's in the chat. He might have a better idea. He's one of our relation guys for Austrade, but on my side of things, I won't have a full picture of how your guarantee works. Sorry. Easy. Excellent. Okay. All right. Well, most people, you can give yourself a pat on the back. So I saw there was 11.5 in there. It was a bit of a trick question. So what happened was it was 9.5 for a long time. Then every year or 2 years, they incremented up 0.5%. It has, for most private employers, now stopped at 12%. That was the increase. So essentially, they kept creeping it up 2.5%. However, APS usual amount is 15.4%. So you're getting 3.4% more than what the usual amount is on the street. There's some other groups around that do 15.4. There's some other groups like Defence. Some of the state police departments pay higher. They're really trying to do a recruitment drive, so they're offering higher super contribution rate. But just remember, if you're ever comparing your salary to outside APS, just remember that you do get a higher amount there. So just calculate that in if you're ever looking at comparative roles outside. So we've done a little bit of a smoothed out chart on, what that extra 3.4 might mean over a lifetime. So based on our projections, it's around about 370,000 higher at age 65, based on just that small extra 3.5% every fortnight going in and being invested on your behalf. Now, obviously, charts don't normally look like that when you look at the history of investments in super. So this is just, a smooth one out, and sometimes you'll see it a bit different out there, but it does make a big difference over time. So even if you can't afford to make any extra contributions right now, just remember you are still being paid super at a higher rate than someone on the same salary in the private sector that's being paid the minimum SG amount. So I often speak to grads about this stuff where, parents are saying, you've got to put a bit extra away and things like that. Just remember that you already are putting extra away. You're probably putting away, a bit extra more than your parents or whatever it is as well. So it does add up over time. The beauty of compound interest, it just keeps getting better and better the longer you have. So you can still consider making voluntary contributions, as not only will you benefit from over the long term, you'll also get some super tax contribution concessions above what your employer pays in. So I'll just quickly touch on all the different options that sit in there. So when we talk about super contributions, they usually fall into a couple of main categories. Concessional contributions. Concessional just means that they're before income tax contributions. So they're taxed at a lower rate. The easiest way to think about these is it's like the concessional bus fare for students and retirees. You're not paying full freight to go on the bus. You're not paying full freight income tax on your contributions. So we talked about it briefly before. That concessional contribution is only taxed at 15%. If your marginal tax rate is much higher, 30+%, then you're actually not paying as much tax on your savings for retirement. Now, the non-concessional contributions, that after income tax contribution, that just means you've been paid, you've paid your tax on the contribution, like your income tax, it's in your bank account, and then you've transferred it into superannuation. You don't get taxed on that one on the way in because you've already paid the tax of income tax, the higher rate amount. So let's start on concessional contributions. Before that income tax is applied, the most common one you'll see of this is your super guarantee or your employer contribution. This is the compulsory amount that your employer has to pay into your super. If you're a PSSAP member, that's that 15.4% of your salary. If you're in a different fund, it's at least 12%, and that's the current legal minimum super guarantee amount. There's some other voluntary contributions you can make. The most common one you see or hear about in the workplace is salary sacrifice. This essentially means you ask your employer to put a bit extra into your super before they charge your income tax on it. So pre-tax income, they'll move it into super first. You only pay that 15% tax as it goes in. The other one that we see as well this time of year, just before we hit 30 June and everything resets, is the personal tax deductible contribution. That's when you transfer money in from your bank account. So you've already paid tax on it, but you transfer it into your super and then later claim as a tax deduction the difference in tax that you've paid. So all these concessional contributions are taxed at 15% inside the super fund. For most people, that's lower than the tax they normally pay on their income. That's why it's called concessional. It's the cheap bus ticket or train fare. You're getting a tax concession or benefit. There is a cap. There's a limit on how much you can contribute this way. This financial year, it is $30,000 per financial year, and it includes your employer's contribution. So say you're on $100,000 a year income, there's 16.4% or $16,400 being contributed in. That leaves that 13,600 odd gap up to that $30,000 per financial year. It is indexed, so that has been creeping up for a while. So it's been $30,000 for a couple of years. Before that, it was $27,500, and I think from 1 July, it's going to go up to $32,500. So it's worth remembering that because there is a little bonus around it. If you haven't used all your cap in previous years, and your super balance is under $500,000 or under $500,000, you might be able to carry forward those unused amounts from previous 5 years. So just remember, if your balance is under $500,000, you can actually use some of that amount for previous years to add into super. It's whether you do it through salary sacrifice or you claim the add funds in, claim a tax deduction. Some people might use it if they got a bonus, for example, or a windfall. They'll put money in, use those previous financial years above the 30,000. They'll get a tax deduction for themselves in the financial year, so it lowers their income and they might get some tax money back. So just remember that's something that you can do. So let's say you're, we talked about 16.4%. They did the same last year. Well, then you'd still have, 13,000 amount there that you could play around with as well. So just double check that on the ATO portal before you do it. So if you log into MyGov, ATO portal, check your contributions history. It'll tell you how much extra you can put in and claim a tax deduction for, or if you're looking to salary sacrifice, something like that. Just double check everything and work it out that way if you're looking to maximize it for yourself. The second type of contribution is called a non-concessional. That's that after-tax one. I won't spend too much time on this. These are kind of rare occasions that people are trying to look at putting a lot bigger lump sum in. So normally they're working with their accountant or financial advisor to do this. Remember, you're not claiming a tax deduction for this one. People usually make these non-concessional after-tax contributions when they've reached their cap, so that 30,000 cap, or used all the previous year's unused cap, and they've received a large sum of money, selling an inheritance, selling a property, those kind of things to really, if you won the lottery, well done you, putting that extra in. And because you've essentially already paid tax on it, the current annual limit on doing that is 120,000 per financial year, because you've already paid the tax on it, right? So there's not as much of a, I guess, gain from an annual tax return point of view, because you've already paid the tax on it. Like the concessional cap, where you could go backwards and use previous unused cap, the non-concessional one actually looks forward. So you can go 3 years forward. So in theory, it's 120,000. So you use 3 years forward, 360,000 in one go. And you can actually put all that into super, but you won't be able to make any more non-concessional contributions for the next 3 years, because you've used up the future 3 years. So in theory, say you did $120,000 right now into superannuation as a non-concessional, you waited until the start of July, you could still then use that 360,000. So within a few months, because of that financial year hurdle, in theory, you could actually get about 480,000 in there in that window if you're looking to do that. So there's those contributions. There's some other ones down there, like things like downsizer contributions, where you can downsize your house and stuff like that. But that's probably going a bit too far into it today. We can touch on that another time. So the last thing I'll touch on with contributions, whether it's before or after tax, they are preserved in your super. And preserved means you generally can't access them until you meet a condition of release. So for most people, that's like reaching your preservation age of age 60 and retiring. So age 60 onwards and you retire from the workforce, you've met a condition of release, you can access your super. If you're still working, you can't access it until 65. The thing that people always think 67 is the number. 67 is when you can get age pension, or may be eligible for age pension from the government, but you can access your superannuation earlier. So it's really important to consider your overall financial needs before adding additional contributions into super. So just remember, if you're still trying to pay off the mortgage and those kind of things, locking all those funds, or locking large amounts of funds into superannuation until you're 60 might not be the best for your situation. So just consider that. Make sure that it's funds for the future. You're not going to touch them. I'll do a quick little breakdown on how they differ. I'll keep this nice and quick because we've covered it pretty well. So this is based on $100 earned. So on the right, as we look at the screen, that's that non-concessional contribution. $100 earned, you pay 30% income tax, you've got $70 paid into your bank account on that earned $100. You can transfer in $70 to super. There's no sort of contributions tax. The $70 will go in. If you do something like salary sacrifice and you say to your employer, put in $100 into my superannuation before income tax, so salary sacrifice pre being paid, you receive a 15% contributions tax, but $85 of that 100 would actually go into super. And that's why people choose to salary sacrifice. The net benefit for the $100 earned is higher going into superannuation. So hopefully that simplifies it. Just remember, concessional contribution, it's just the cheap bus fare or train ticket when it comes to income tax. So you're paying a bit less tax. All right, we do have a bit of a modeler. And I will show you how to get there as well. I'll just jump onto, I'll see if I've got, I don't have that one loaded, bear with me. Just bring up our website. So this is CSC's website. This is our homepage. It's just csc.gov.au. The easiest way to find our modeler is you're a member. Under members, it should be retirement, and then tools and calculators. There's lots in here. There's risk profilers and things like that. Lifestyle targeting for when you're thinking about retirement, how to optimize your contributions. But the one we want is this PSAP retirement modeler. And I will just put that in the chat for everyone as well, in case you wanted to follow along. And so let's get started. Look, there's lots of details in how we do all the actions and details on here. You know, what our investment returns are, what the fees are, you know, our assumptions based on current tax legislation. You do have to tick the box to say you've read it. But let's go with, we'll go female, 25. And the reason gender is important on this is actually life expectancy. So I don't think we talk about that enough. You know, people talk about gender pay gaps and these kind of things. Also super important. But when it comes to superannuation, women tend to generally live longer. So in my opinion, I actually think women need more super than men, because statistically they'll live longer and by the numbers tend to retire earlier as well. So just be aware of that. Let's go with 25. Salary, let's go 80. And then current balance 50 is fine. So what does that look like when it comes to retirement? And most people go, well, Andrew, how do I know what I need in retirement? Well, there's actually a group out there that survey retirees. It's called AFSA. Actually, I might show you. AFSA Retirement Standard. These guys go around. They actually, Emily, I'm not sure I can. Let's have a look. I don't think I can with this settings. Bear with me. Not at the moment, I'm sorry. But I'll chat to it as we go through. So sorry, Emily. Retirement Standard, these guys go around and actually survey retirees on what they actually spend their money on. So this assumes you own your own home. And they say for a single person, this is as of December quarter, you know, for a comfortable retirement, about $55,000 a year. For a couple, you'll need about $80,000 a year combined income through that. Now, with inflation, obviously, we've had petrol crises, and inflation was 4.6 for the year for I think the March quarter results. So these will go up again. On the far right, the age pension, so that 30,646 as a singly. So just remember, these are the numbers to start to work off. Obviously, if you live in a capital city, that's probably not going to be enough. This is an average across Australia, so just be aware of that. But just for this, I'm going to put up to 55, just for where we are at the moment. Cool. Bottom left. Let's have a look. It doesn't actually let me, yeah, excellent. Sorry, that's, thanks, Jonathan. Thanks for jumping in there. I've tried to do two things at once and lost my train of thought. Well done, me. So we're at 55,000. Okay, so this is based on retirement age 67, which is age pension age. But what if we want to retire at 60? And what if, you know, you're not getting 15.4% for all your career? You're only, you know, doing it for the next sort of, let's go 10 years. So what happens then? So as you can see, we've got a run out age at about 90, and maybe we want a bit more. So what if we do $100 per fortnight? So what's that? $2,600. So all of a sudden it makes a huge difference in what you might be retiring with at 60. So we've got this modeler here. Please feel free to use it. There's lots of great things in there, like you can add part-time work, maybe from 60 to 65 if you want to add part-time work, but play around with it. And that one's there for you. But I'll show you some of the other stuff that's in there as well. So that's contributions. and play around with those. Have a look and go, do you know what? I'm on track. Maybe I don't need to make any contributions. Fantastic. Maybe you can, pour more money into the mortgage, something like that, that non-deductible debt. Do I have a car loan? Pay that off first, those kind of things. But just be aware this is here. Start to think about all these different options for you. All right. So that's contributions, and we can go back to all the questions on that. I'll just double check again if there are any more questions. No, nothing there about contributions. If you think of something, put it in. I'll jump in at the end. So let's start to talk about investments. So for those who aren't familiar, your superannuation money is invested to help it grow over time. Even if you've not made any decision on your investment, we have a default fund that we put you in, and that's the same across superannuation industry. Everyone has a default fund that members start in. But the choices you make now about how your super is invested will really affect how your money moves and grows as you head towards retirement. So it's important to just take a little time to understand the investment option you're in now, make sure it's the right one for you. And if it isn't, I'll show you how to change it, and give you some ideas around the different options that we have with CSC. Now, if you're a member of other funds, other funds will have different investment options with different names or similar names, but they might have very different investments underneath. So the big factors for me when I talk about investments are really about time. So how long you have until retirement, or how long until you need those funds, and how comfortable you are with seeing your money go up and down, or volatility, investment risk is another way of saying it. So if you've never changed your investment portfolio within your superannuation fund, you are in My Super Balanced. It's our default fund. It's our kind of medium growth, medium risk sort of fund, I would say. It's based on a classic 60-40 balanced portfolio, and that's what most super funds default fund is. It's designed around 60% in growth assets like Australian shares, international shares, property and infrastructure. So things like office towers, infrastructures like toll roads, bridges, those kind of things. There's some alternatives in there. And then the defensive part, that 40%, is really fixed interest. So government bonds and cash, things like kind of like your term deposit style investments. So those defensive assets, they should be valued at a certain amount. They shouldn't be going up and down, and they're just paying you interest for your investment time or giving money away. The growth assets, well, you get a higher rate of return on those because there's more risk. The value of that investment can go up and down, and over time, ideally, it's going up and paying you dividends and things like that, a higher rate of return because of that volatility that you're experiencing. So that's that 60-40 portfolio. It moves around a bit, could be anywhere up to 70%. That one's designed for people with around about a 10-year time horizon. So late career, will need some funds going into retirement. When they plan to retire, they plan on drawing out on their super, 10-year time horizon. And they assume over that 10-year period, there's probably a 1 in 7 chance of having a negative year return. So there's a chance of loss, but over the long period of being invested, it should perform better than something like income focused. So income focused for us is really a pre-retirement or retirement designed fund. It dials down those growth assets. So you might see 40 or 50% in growth, 50 odd percent in defensive. And its returns, it won't have as high returns when the market's really going strong, but it should smooth out any losses as well. So it's designed around having a 5-year time horizon and going into retirement, or income focus. So you're looking at dividends and cash returns, interest payments. And then cash is cash. It's the most defensive. Unfortunately, we see at the moment with inflation so high, The cash rate of return, if you're only getting 4%, on your term deposits and savings accounts, but inflation is say 4.6% for the year at the March quarter, your purchasing power is going backwards. So you're actually 0.6% worse off on purchasing power of a basket of goods. And so it is defensive, and it's really designed for, short term, maybe 12 or less months. It's designed to use it. So you might see people coming into retirement, they're worried about, the markets going backwards and losing money on their super. They want to pay off, say, part of their mortgage with their superannuation fund. So maybe as they're going into retirement, instead of being in balance, they might go into some income focused or cash for a portion of their investments. And that way, when they can access it when they retire, they know that that fund's going to still be there. Even if Trump does something crazy and markets go haywire, they've protected those funds and know that that'll be paid off. Yes, you might have missed out on an extra couple of percent return over that period of time, but you've mitigated, market crashes and things like that. So this is what you can do. You can start to mix and match and play around with it. On the other end of the spectrum, maybe your early career, you've got 40 plus years until you can access this in retirement. You don't mind if markets go haywire, because if markets fall backwards, it just means you're getting it cheap and you've got time to ride out that that volatility. So aggressive is designed for people with more than 15 years as their time horizon for the funds. It's designed really around all growth assets, so it's only about 10% defensive. The rest is in, equities, so shares, Australian, international, global shares, property and infrastructure, toll roads, bridges, office spaces, those kind of things. And it's all about getting over the long period of time the higher rates of return. So when they get to retirement, yes, they've seen markets go up and down through that time. It just means every fortnight they bought it cheaper, and it keeps growing over a long period of time. So as an example of that, I'll give you this chart here. So this is a window up till the end of 2024, and I'll show you on our website where you can check this regularly. We saw through COVID that big pullback, and as you can see there, that aggressive one, it's got the most growth assets. It pulled back the most, whereas something like income focused and cash, very small pullbacks. The reason being, they're not exposed as much to all that market volatility, so the rates of return were much smoother and protected. So you can mix and match your investments in these. You can go 100% in one or another, but they're all designed around, longer time horizons and things like that. So aggressive, 15 plus years. If you could have held that over the longer term, COVID doesn't really matter. You're well and truly made up the difference over that period of time. However, if you were planning on retiring in 2021, that pullback that you saw may have really affected how much you're retiring with. Do you have to work a bit longer? Those kind of things. Do you cut your spending when you retire if you plan on the same time? So this is something that you can change. You can actually jump in and change it daily. Remember, they are designed to be held for a period of time, though. So that's investments. I won't spend too much time, but just when you're on that calculator, you can update the mix. So, for example, we keep the 4, so it matches your investment options. And I know that it's a bit of a chart crime there. The number goes up, but the graph goes down. But it is make a big difference over that period of time. Historically, it's about 2% difference year on year, say between aggressive or my super balanced, and then the same again on income focus. That's pretty rough, but around about 2% difference over the long period of time. The difference in return by taking on more aggressive. All right. I'll jump through that. I'll check if there's any questions on investments. Nothing yet. Hopefully it's clear as mud now. And we'll jump onto the last part of the presentation for you as well. Bear with me, I've done it again. Let's talk about probably the least likely thing out of all this to happen, but We talk about superannuation as financial security in retirement, but it can give you that peace of mind during your working life with the insurance offering that sits within it. So let's have a look at the insurance cover that's offered within the fund. When you joined, depending on your age, you might have defaulted in and you could have opted out and got your own insurance, or it may sit in there. But essentially, in the event of sickness or injury, where you're unable to work temporarily or extended period of time, or worst case scenario, you pass away, as a member, we have insurance and we have you covered in there. So I hope you never face any of these situations, but just knowing that you do have insurance if it does happen, and that your loved ones are covered and you're prepared, hopefully offers a bit of peace of mind. It is paid for out of your superannuation fund. You don't have to find extra money for it. It does sit in there. So let's quickly talk about the different types. So income protection, this one replaces part of your income if you're unable to work due to illness or injury. So it's like it's that fortnightly payment for you. The default cover you receive depends on your age. So it'll be either for 2 or 5 years. You'll receive 75% of your income for the first 2 years. If you have the 5-year option, it drops to 50% of your income for the next 3 years. And in addition, whilst you're receiving income protection payments, you'll also continue to receive your 15.4% super contributions. It's made on your behalf. The idea there being you're not in a worse position for having that period of time off. So you're still going. If you're ever comparing the income protection inside the fund, just remember a lot of the funds outside will only offer the 12%, that super guarantee amount. The reason we do the higher rate is because we understand that's APS. So that's part of our offering. So that one, I've seen a previous financial planning colleague of mine. He was riding an electric scooter to work in the wet in his suit, jumped off a gutter, crashed and broke his shoulder and did his elbow and everything else. He couldn't really do work for about 3 months it was, and half of that was the meds to do with pain and things like that. We traded in client money. It's financial. You can't actually do that if you're on painkillers and things like that. So he actually had to have time off work, and so he had that income protection coming through, paid for him, so that he could still pay his mortgage and things like that. Something that's a bit more serious, total and permanent disability, or TPD. This one's slightly different. It doesn't pay it like income, it's a lump sum. So if you're permanently unable to work again due to illness or injury, you might have used up your sick leave first. If it happened at work, there's Comcare. Then if eligible, you can receive your total and permanent disability lump sum through your insurance. In some cases, depending on the situation, your existing super balance might also be paid out. So just be aware there may be tax implications if the payment happens before retirement age out of super. But essentially, to qualify, you must be unable to ever return to work or reasonably retrain to work again. Some of the common ones we see around this are trauma events, like car accidents, car crashes, things like that, cancer, and even seeing a little bit more around the mental health stuff as well at the moment. So just be aware that, look, it's not super common, but it is there and it does happen. So that's what it's there for. Then finally, death cover, or I feel like it's ironically named life insurance. This one pays out if you pass away or diagnosed as terminally ill. So the payout includes your insurance amount and your super balance as a lump sum. If you're diagnosed with a terminal illness, you may be able to access these benefits early. I think that's kind of surprises a lot of young people who assume that the death cover isn't useful until later in life. But essentially, knowing you have that access, if you become terminally ill, might just provide reassurance around, you don't have to work right up if you need to afford to still pay the bills and things like that. So just be aware of that one's available, as well as terminal illness. You can also decide who gets your super if you pass away. So there's two ways of doing this. One of the ways most people think is just part of their will, but you can actually choose who your super goes to before it even gets to that. So there's what's called a non-binding nomination. That just means it's like a guideline for us, the super fund. And then there's a binding nomination. Now, this is where you have to print out a form and sign it and send it through to us. It legally tells us, the fund, who to pay. So once we accept that nomination, that's who we have to pay, and that'll be your life insurance payment and your super if you pass away. One of the big factors in doing a binding nomination is actually the speed at which payments are made. So, it's unlikely that it can be contested because it's a binding nomination. That's who we have to pay, and it doesn't form a part of your estate as your will, so it can be paid straight away. So for those that, married and maybe have kids, they might want to make their spouse their binding nomination so they know that they're going to get the funds straight away, and really make sure that anything that needs to be paid for can be paid for. So the whole idea about that one's just making sure that your loved ones get the funding that they need as soon as possible. Hopefully it gives you a bit of peace of mind that, these are my wishes. I want these funds to go here. It doesn't have to be one person. So if you've got kids, for example, 2 kids, you could split it up 50-50. They don't have to be dependents, so it could be adult children as well. But you can actually nominate that as well. You can actually tailor your insurance, so you can apply for more. So to receive default insurance, meaning that we've automatically applied it, you need to be over the age of 25 and have a balance over 6,000. If this is not the case for you and you want to have insurance applied earlier, it's possible. You just need to opt in for it, as the cover will only become automatic once you reach those 2 conditions. The government changed some rulings around that a few years ago. What was happening is young people had lots of different super funds from lots of different jobs prior to their career. And so these insurance premiums were eating up their super. They might have 3 or 4 different super funds. So, you've got to have 3 or 4 different insurers. Policies. So therefore, they said, no, it's got to be over the age of 25 and a balance of $6,000 before we default people in. I think it's a really good change that's been made, and making sure that, people's super funds in the early years aren't wasted, because most young people don't put too much attention on their super, unfortunately. So I think it's a good change, but that's how it works. When you might want to review your insurance, apply to increase it, those kind of things. The big ones for me, and the thing I think about, is family. So, married, things change there. Do you have kids? Those kind of things. Divorce, another big one, making sure you've got everything up to date. What changes there? Health events, again, change everything as well. So making sure that you've got the right insurance set up for that. And then finances, when you start furthering your career and, pay rise, promotions, those kind of things, that's a great time to check your insurances. The other thing as well, maybe you've paid off your mortgage. Maybe you don't need as much insurance, for example, as you do. So maybe you can dial it down. Don't forget about that. What if you're getting close to retirement, everything's paid, you've got a nice nest egg saved. Maybe you don't need as much income protection for years. If you're retiring in the next few years and you've got the money there, if you need it, maybe you don't need that as much income protection. So it works both ways, increasing, decreasing. Just remember you can do that as well. Set it up for yourself. It's all about you. But log into your account, check out our CSC navigator, check where you're at, what your insurance is, what your balance is, where your investments are, and have a look at that. These are all old awards. All the ones for 25 just came out last month, so I'll skip this page completely. It does bring me to the end of the presentation. The one thing I'll flag is We do have an Instagram handle, so it's my team, the Super Education team. Ange from our team runs it. She does a fantastic job. If you're on Instagram and you just want nice little quick updates around what's going on, end of financial year will come up. You'll see some pop-ups on there, or what we're doing, we're getting around the country chatting to people and making sure everyone's getting their super dialed in nice and tight. So jump on there if you want to see what we're up to, or you want quick helpful tips. A little checklist for you. Choose your investment option. We talked about that. Make sure it's the right mix for you. The default is not the right mix for everyone. Review your insurance, increase, decrease. Is it okay? Find and combine your super. If you've got other super funds and you keep going, I need to bring them all together. If you log into your online portal, there's actually, I think it's on the home, the first screen, it says consolidate. Go in there, you put in your tax file number and details. We can actually request to get moved across on your authority. Or the other way of doing it is logging into your ATO portal and pushing away like that. And lastly, if you need to, consider additional contributions. I'm also a massive fan of servicing debt, paying off debt that you can't get a tax deduction on the interest of. So like primary residence will put you in a better position. Investing may put you in a better position. So just remember that. And then if you want a one-on-one with one of the super specialist team, a lot of alliteration going on today, scan to book with our CSC super specialists. So you can join in there. They will give you 30 minutes. It's general advice, but you can kind of dial down on the questions you have around your specific fund, where you're at the moment. Do you want to talk about investments? Do you want to talk about, all right, walk me through things to think about when I'm choosing to do extra contributions, stuff like that. Same with insurance. So super specialists are there. It's 30 minutes. It's a free consult. It's part of your membership that we offer to you. So please feel free to use them up. It's there for you. It's all about you. And they can do that virtually as well. So I'll stick around for a few more questions, but hopefully that one answers most of the things about superannuation today. Thank you so much for joining. If you've got everything you needed out of today's session, please feel free to go about your day, and I'll stick around for a few more minutes while we go through questions. Thanks, Teddy. Thanks for putting the links in there. Excellent. Great question. Binding is paid straight away. What about non-binding? Can you please explain it further? Yeah, so non-binding, we use like guidelines. So you can just log in online and update a non-binding. It's who you prefer your super to go to. It isn't legally binding, but we'll try and make the decision as appropriate with that super law. So if they're a beneficiary, for example, it's going to make it easier for us to make that decision. However, that binding form is the one that legally binds us. Once we accept it, that's who we have to pay. It does refresh every 3 years because life happens, marriage, divorce, death, all those kind of things change and refresh that stuff. So you've just got to submit the form every 3 years to make it binding, and it does pay it a lot quicker. We're talking weeks rather than months. We're not waiting for probate with the will and those kind of things. Hopefully that helps. Awesome. No more questions coming through. I'm just going to quickly scroll up. Nope, nothing there. Excellent, Teddy. Thank you. Recordings will be available. Excellent. Lisa, you're 100% correct. It is super important. Excellent. I'll end the event there. Thanks, everyone.